The most powerful number in your life isn't your salary, it isn't inflation, and it isn't even how much money your government owes. It's a number most people never see, and when it moves, everything else follows. Right now, that number is deciding whether businesses hire or fire, whether homes are affordable or impossible, whether governments spend freely or quietly panic. That number is the interest rate. And the uncomfortable truth is this: interest rates don't just influence the economy, they quietly control it. Here's why this matters now. Over the last 2 years, central banks raised rates faster than at any point in decades. Officially, it was about inflation. Unofficially, it was about control, because interest rates are the master dial of a debt-based system, and almost everything we rely on runs on debt. Let's start simple. When rates are low, borrowing feels cheap. Businesses expand, people buy homes, governments spend without much resistance. Money moves easily, risk feels distant. But when rates rise, the same system tightens everywhere at once. Loans become expensive, projects get canceled, house prices wobble, governments suddenly talk about fiscal responsibility. Nothing dramatic changes on the surface, no laws are passed, no votes are taken, and yet behavior shifts overnight. That's the first quiet power of interest rates. They change incentives without changing rules. Now, here's the part most explanations miss. Interest rates don't just affect new borrowing, they reprice the past. Every loan, bond, mortgage, and corporate debt stack was created under old assumptions. When rates rise, those assumptions break. Suddenly, debt that looked safe becomes heavy. A 1% change doesn't sound like much, but across trillions of dollars, it's enormous. This is where the math turns uncomfortable. Governments with high debt don't fear recessions first, they fear higher rates. Because higher rates mean more money spent servicing old debt, not building roads, funding hospitals, or lowering taxes. So policy begins to orbit one question: how do we keep borrowing affordable? That's why markets listen more closely to central banks than to elections. This is also why interest rates feel boring but act like gravity. They pull everything toward them. Housing markets respond instantly. Stocks reprice. Currencies shift. Even political promises quietly shrink. Publicly, we're told rates are a technical tool. Privately, they're a restraint mechanism. They slow growth without announcing austerity. They cool spending without saying no. And here's the irony. When rates are low, people blame governments for excess. When rates are high, governments blame markets for pain. But the lever sits somewhere else. Central banks don't decide outcomes, they decide pressure, and pressure decides behavior. Zoom out far enough and you see the pattern. Every modern financial crisis ends the same way. Rates go down, debt grows, assets inflate. Then inflation appears, rates rise, and the system tightens again. It's not chaos, it's a cycle designed to manage risk, not eliminate it. And the higher global debt climbs, the more sensitive everything becomes to that one quiet number. At a certain point, interest rates stop being a tool. They become a constraint, not because anyone planned it, but because the system can't function without cheap borrowing. That's the real reason interest rates control almost everything, not because they're powerful, but because we built an economy that can't breathe without them. So the next time rates change and the world reacts, ask yourself something different. Is this about fighting inflation, or is it about keeping a debt-driven system stable just a little longer? Because once interest rates lose their ability to move freely, the real question won't be what they control, it'll be who controls them.